Peter Rose, Longwood Currency Trading. Good morning. It's early July of 2021, and I was chatting with a friend of mine who's involved in the stock market, does some stock market stuff. And we were talking about the differences and how you get a sense of the different market between the Forex market and the stock markets. And he was commenting quite a bit about he trades DOW stocks. He trades a little S&P futures, but primarily DOW. And we got discussing that, and I said, you know, the average that you're looking at is not really a true reflection of the price movement of the underlying stocks in the Dow 30. And he goes, well, what do you mean by that? And I said, well, your average is way off of what it should be, because there's an anomaly in the mathematics of calculating your average that isn't the case in the Forex market. And so I got to thinking, and I don't think that probably very many Forex traders, let alone folks that are dealing in the stock market, understand the data that they're looking at. And if you don't really understand that data, are you making the correct decisions based on that data? If you're a Forex trader, we don't live in a vacuum here. We're constantly looking at the health of the economies that were involved. So for example, I mean, even if you're not in the United States, the Dow Jones Industrial Averages is one of the most widely respected averages in the world, financial metrics in the world. And so if you're trading in these financial markets, you have to understand the difference in what this data that they're presenting to you represents, because otherwise you're trying to compare, you know, like an apple and a baseball, for God's sakes. I'm going to go over this stuff sort of from only a discussion standpoint, rather than getting at the whiteboard and doing all the math for you. It's not very complicated math, but I just hate being at the whiteboard. It just doesn't make any sense to me. So if you have short-term attention span, you might not get the data here. I have a short-term attention span. That's why I'm looking at my notes from a blog post that I did on longwoodcurrencytrading.com of the same title. And in that blog post, I go through the maths. It's a simple arithmetic, so that you can see all this stuff that I'm going to be talking about here. But I think it's the concepts that are more important than understanding how averages and stuff like that are created, or why there's only 29 stocks in the Dow instead of 30. That's all peripheral to understanding that you may be looking at data and interpreting it incorrectly. And so that's why I would suggest, if you've never been to my blog site, check it out. But particularly if you're interested in the content of this video and finding out what I'm talking about and the differences in how you're looking at market Forex data as opposed to looking at market stock data. For example, and we're going to use the Dow as an average, you know, for all that stuff. So check out the blog post. Anyway, I'm looking at my notes here to make sure that I'm staying on track, and I don't want to get too involved in the video on Forex pricing, because it's fairly evident that you have pound dollar, for example, and so you're looking at the value of how many dollars will 1 pound buy, and so 1 pound will buy $1.38 of US dollars, which means that it's 38 cents per dollar more for someone from the United States visiting Britain to buy a loaf of bread or go to the movie or whatever. That's the pricing of that Forex market. But you might be tempted to say, well, you know, that's all I'm interested in, is that whatever your favorite pair country is. I'm in the United States, so I look at the the US dollar in relationship to the pound or the yen or whatever. And in fact, all of the majors are US dollar based, whether it's a base or quote currency. The US dollar is in there, in the yen and the Swiss franc and the pound and all that other sort of stuff, because those are the major economies that are interacting with each other that cause the majority of the volume of the country. And so it would be helpful not only to know what the pound dollar was or the dollar yen or whatever, but how is the dollar performing within the market of dollar oriented currency pairs. And so that's averaging the Forex market with just a certain number of pairs. So there are, I think, 6 of them in the DXY, the dollar Forex index. And it's similar to the, out of the, I don't know, 4,000 stocks that you could look at, there's 30 big industrials that are in the Dow, or you can go to the Russell 2000 or the S&P 500 or whatever. You're looking at segments of the market that are similar, so that you get a feel for how things are going. And so it's no different in the Forex market. And I wonder how many Forex traders understand that there is a DXY USD index. There's a pound index, and there's every pair you can have an index with the major countries that are trading partners with the pound, for example, or the dollar. And so if you, and you really need to do that, because, for example, if you looked at 3 Forex pairs, the GBP USD at $1.38, the AUD NZD at 1.07, and that's in New Zealand dollars, and the CHF CZK at 23.40 Chaz Crony. So you're looking at 3 currency pairs, and if you divide those values by 3, the answer is 8.6186. Well, yeah, but what does that mean? It doesn't mean anything, because you're mixing you're mixing apples and baseballs. You're mixing GBP USD in US dollars and AUD NZD in New Zealand dollars. So if you put the 2 of those together and average them, what does that mean? It doesn't mean anything, you know. So you have to. That's why I say you have to pick one currency like the USD, and then compare that against. Well, let's compare it against the euro, the Swiss franc, Japanese yen, Canadian dollar, British pound, and the Swedish krona. And the calculations for how the DXY is computed it's not complex, but it's a weighted average, and they're all multiplied together, which isn't like what happens with the Dow, and I'm going to explain that in a second. But that average, the DXY, is a valid representation of the performance of the US dollar in relationship to the other 5 currencies in that averaged market. Okay, let's look at the stock market. And I don't want to look at all 30 Dow Jones stocks, and actually there's only 29 in the Dow. If you go to my blog post, there's a link there that describes when and why we went from 30 to 29 Dow stocks. But regardless of that, instead of looking at the Dow itself, I'm going to create a new stock market index called OAK, the Organization Against Kryptonite, and it's just going to have 3 stocks in it, A, B, and C, and each one of those stocks only has 1 share. Okay, so I got 1 share of A at $30, I got 1 share of B at $30, and I got 1 share of C at $30. The sum of those is $90. And what's the average? You divide by 3, you get 30. How quaint is that? Okay, so if the price of, in the oak market, if the price of C increases by $1 to $31, and you add all that stuff up, it comes to 91 as the sum, and you divide by 3 and it comes to $30.33 a share. Okay, well, so what? Well, by increasing, and this is important, by increasing the value of one of the stocks in the oak index, $1, the average increased by 33 cents. Fair enough, right? That's what the average is. Okay. So let's take the 3 oak companies at 30 bucks a share. And company C says, gee, you know, we'd be better off if we had a $15 price instead of a $30 price, because more people would want to buy our stock as opposed to the other two, because you got to pay $30 a share for those, but here you have to pay $15. But the company value remains the same, so you have a stock split, and you issue another share of stock, so now you got 2 shares of company C, each worth $15. Company C is still worth $30, okay? So it didn't change anything. Didn't change anything. You still have 3 stocks. A has 1 share, B has 1 share, and C now has 2 shares. They all have a value of $30, but the stock prices of the 3 have changed. A is equal to $30 a share, B is equal to $30 a share, but C is now equal to $15 a share. So if you divide that by 3, because there's 3 stocks in there, what are you going to get? You're going to get an average of $25 a share. But you were just at 30. The market closed at an average oak average of $30 a share, and now you're going to open that market the next day, and the average is $25 a share. People would go crazy. You know, that's like the Dow closing at 30,000. It's 34,000 now. But let's say the Dow closes at $30,000 on Tuesday, and it opens up on Wednesday at $25,000. People go, wow, what happened? So you can't do that. You're going to have the average open at the same level that it was, because the capitalizations of the companies didn't change. The values of the things didn't change. The market just closed and opened the next day. So the average has to be the same, right? And so the question becomes, how do you get a stock to split and get the same average that it was before the split? And there's a little math to that, and it turns out that if you divide the oak share price, total share price, the 30, 30, and 15, and you divide that by 2.5, and there's math to figure that out, then the average comes out to be 30, and that's what you want. So what you have to do is change, in stock market, you have to change the divisor every time a stock splits or changes, in order that the price average remains the same. So now look at the complication here. You've got 30 stocks in the Dow, and they're changing and splitting and stuff all the time, which means the divisor is changing all the time. The math for all that, or the arithmetic is all that for all that, is in the blog post. So check that out. So let's do this now. Let's take the oak market. We have 3 stocks priced 30, 30, and 15. Let's say that now, and the average is 30. Now, one of those stocks, doesn't matter which one, goes up $1. So now, instead of a $75 value, which is the 30, 30, and 15, instead of a $75 value, you have a $76 value. What does that do to the value of the average if you divide it by 2.5? Well, that average now becomes $30.40. Remember, before, without the dollar rise, it was $30.33. One of those stocks goes up $1, and so now the average becomes $30.40. It's 7 cents more. The average is 7 cents more than it was when before a pre-split, when the stock went up $1. In other words, if you had 30, 30, and 30, and the stock goes up $1, price in the open thing would be at $30.33. After the split, and you have a stock go up $1, you get an average of $30.40. So you've had an increase of the volatility of the average by 7 cents, but nothing has changed other than the price of one of those stocks pre-split and after split went up $1. So in one instance, the dollar increase caused the average to go up 33 cents, but after the split, that $1 increase caused the average to go up 40 cents, a 7-cent difference, just because of the split. And why is this a problem? Well, because nothing happened. Nothing happened to cause that volatility to go up. It's phony. So look, when the Dow was established, the divisor was 30. Okay. Because of all the splits and things, as of 2018, actually June of 2018, and this is reflected and talked in detail in the blog post, but in June of 2018, the divisor on the Dow was not 30, it was 0.14748, whatever. It went from 30 in whenever the Dow started to 2018, and that's a long time. So the divisor has changed from 30 all the way through. When I first started looking at the stock market back in early 1980s or something, the divisor was at 5 or something, or 3. I don't know what the divisor was, but it wasn't 30. But now in 2018, the divisor is 0.14748. So now, and that number is even lower now in 2021 than it was in 2018. But in 2018, a $1 change in the price of any of those Dow 30 stocks caused the average to go up $6.78. So a $10 rise, it would cause the average to go up $68, for example, in the Dow. Let that sink in a little bit. $1 rise in that average causes the average to go up $6.78. I mean, that's just amazing. I did some research on the Dow the other day, and if you add up, I added up all the closing values, and it came to, of the 29 stocks, it came to $5,023.40. That was the Dow average, or that was the sum of all the closing prices. And if you divide by 29, the average is $173.22. However, on the same day, the posted average for the Dow Jones was $34,501.94. $30,000, almost $30,000 more than the real average. Now, if that doesn't make your roids flare up, I don't know what would. It just doesn't make any sense that that anomaly is there, and so few people realize that. I mean, you turn on CNN or something, and everybody's going batshit because the Dow Jones went down 400 points. The world is coming to a 3 stocks went down $4 each. I mean, it causes a $300 decline. It's fantasy. And yet, the health of the economy, whether it's the Dow or the S&P or the DAX or the Hang Seng or whatever it is, the health of these economies are being based on this irrational volatility. And look, we're not going to solve anything. We're not going to change it. That's just a fact of life. But the takeaway here, that as currency traders, we have to be aware that any averaged financial market where the divisor needs to be adjusted in order to keep the published average consistent creates a magnified average, as opposed to the Forex market, which has none of that shading. In Forex, the price is the price, and the average of those prices for a currency pair set, a set market, is the average. Just something I thought that I might bring out so that folks are aware of that. I know there's some stock folks that watch my channel as well as Forex people, but just be aware that when you're looking at price information or published data, or once they start to manipulate that into averages and moving averages and all that other sort of stuff, you got to make sure that you understand how those calculations are arrived at, and do they make sense for the data that's being presented, that the individual data points are reflected in that average. If you're not aware of this, and you're not taking it into account, and look, we're not trading the Dow, right? As Forex traders, we trade Forex. But we still look at what the Dow is doing, because the economy of the U.S., for example, is reflected in that average. So if that average is going up, it means that the country's health is better. Or it could be that just inflation is going crazy or something like that. I mean, but you have to know the difference of that. Because if you're trading a USD-based pair, you better know what the Dow is doing, and you better know what the corresponding market indexes, stock indexes, which are reflective of the economy of that other pair country, what they're doing. You got to know what the interest rate is situation in that pair country, as well as if you're trading USD and you live in USD, United States, you got to know what the interest rates are and what the ramifications of a change of interest rates up or down are on your stock markets, and how those affect what you see in the value of the dollar. If the interest rates go up, the dollar goes up. If the interest rates are down, the dollar goes down. Why is that? Well, I don't know, guys. Yeah, gotta figure that out. All I want to point out to you is you got to watch out if you're looking at an average where the divisor has to be changed because of something happening in that market. And please go to the blog post and read that post and see what you think. And if you got any questions or whatever, I mean, I'm not an expert on all this stuff. I just recognize this anomaly. For example, in the Dow back in the mid-'80s, when I was looking at this stuff, I don't know very many people that are aware of it. And so, I just thought it'd be important to sort of make that apparent to the Forex folks that are trading, because not only if you're just trading Forex, don't you really pay attention to the overall general underlying stock markets and economies of the countries. You're just sitting there trading squiggly lines. You got to know this stuff. You don't have to be an expert at it, but you have to know that certain things are going to cause your currency pair to go up or down. And it isn't because it's raining out. It's because of economic conditions in the pair countries playing off against each other. And the reflection of those economic conditions is in the stock markets. But those stock markets are looked at as averages, and those averages are skewed because of the divisor problem. Please just bear that in mind. And thanks for watching. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.